What's going on, everyone? We're going to talk real quick about iShares again, the ETFs issued by BlackRock, and why they have that XTSLA fund in it. I just figured it out because I reverse engineered their share lending program and how it works. So let's go ahead and take a look here. This further confirms my theory that this is all one giant share lending mess. And the reason why the share lending is taking place now in the ETF market is because, again, we all turned our share lendings off. So, I mean, yeah, it is what it is. But basically, securities lending is a well-established practice where ETFs make loans of stocks or bonds to seek an incremental increase in returns for fund shareholders. This paper explains the basics of securities lending, outlines the benefits and risks for investors, and describes BlackRock's approach to its securities lending practice. So basically, in securities lending, ETFs lend stocks or bonds to seek to generate additional returns for the funds. Here's how it works. First, a large financial institution like a bank, market maker, or broker-dealer, or authorized participant, otherwise known as, asks to borrow a stock or bond from an ETF issuer, or BlackRock. In order to get the bond or stock, the financial institution will negotiate financial terms with the lending agent of the ETF and provide collateral. The ETF keeps the collateral to secure repayment in case the borrower fails to return the loan, stock, or bond. The value of the collateral is required to be at least equal to the market value of the loan, stock, or bond. The financial institution typically uses the stock or bond to hedge against market risk, facilitate a short sale, or to use as collateral in another transaction. So there you have it right there. There's proof of the pudding right there. What are these securities lending transactions being used for? To short a stock, hedge against market risk, or to use as collateral in another transaction. Benefits: ETF investors can benefit from securities lending in the right form of fund performance. How? The ETF seeks to generate additional income through the rate that it charges for lending securities, and or income on the reinvestment of the collateral that the borrower provides in exchange for the loan. In summary, while not without risk, securities lending seeks to benefit the fund. BlackRock is focused on delivering competitive returns while balancing return, risk, and cost in its 4 decades of lending securities on behalf of shareholders. Since 1981, BlackRock has delivered positive monthly lending income for every fund that has participated in securities lending, including iShares ETFs. Whoa. What's going on? Here's an example of how it works. So let's take, for example, the IWM with a lot of AMC in it. So step 1, a large financial institution, right here, asks to borrow a stock or a bond from an ETF. So they run over to BlackRock, and the ETF says, hey man, you're going to need some collateral to secure this loan. So once the collateral is received, the ETF lends the stock or bond to the financial institution or the borrower. So step 1, I'm going to give you some collateral, you give me some ETF shares. That happens. Now, while the security is out on loan, the ETF invests cash, or the ETF being IWM, invests cash collateral in a money market fund, or Tesla, XTSLA, to seek incremental return. If a security pays a dividend or another distribution while on loan, the borrower will pay the ETF what the ETF would have received if it had been holding such security. So if there's a dividend released while this bank is holding it, it must pay the ETF out the dividend. Okay? So now, to end the process, step 5. At the end of the loan term, or at the ETF's request, the borrower must return the security back to the ETF. Lastly, the ETF then releases the collateral back to the borrower to close out the process. Now, these are all of the ETFs that was just listed a couple slides back. We have IWO with XTSLA, 0 AMC, 0 GME. We have IWM with AMC and XTSLA. Now, by the way, I did cut and paste this stuff, so this is not necessarily the exact order of the fund breakdown, except for IJT, IJR, and IWN, I believe, is how they really are. But as far as ones with GameStop and AMC in it today, all of the funds that we're seeing, all of these iShares ETFs with XTSLAs in it, you know what that means? That means these ETFs are currently active in share fucking lending. So we got lending now, since we can't do it through the broker dealers, remember? Because we turned it off. We turned our share lending off through the broker dealers. So how do they do it? Through ETFs. Oh God. So collateral reinvestment risk. The risks. While every investment bears some risk, BlackRock takes a rigorous hands-on approach to securities lending and has delivered positive lending income for every fund that has participated in securities lending since 1981, including iShares ETFs. The primary risk of securities lending are borrower default risk and collateral reinvestment risk. Securities lending involves the risk that the borrower may default, including by failing to return the securities in a timely manner, or at all. In order to minimize the risk of borrower default, each borrower is assessed by BlackRock's internal risk department and monitored over time. The risk team performs regular borrower reviews. New transactions are systematically prevented if a borrower reaches internal limits. Collateral reinvestment risk. When an ETF receives cash as collateral, it may be reinvested in a money market fund with the objective of preserving principal and liquidity while generating income. This reinvestment of cash collateral exposes the fund to various investment risks and the potential loss of principal. These risks include market, liquidity, and credit risk and are not covered by BlackRock's borrower default indemnity. Market risk is the potential for losses due to changing prices. Liquidity risk is the possibility that securities or instruments in which the cash is invested become difficult to sell or can only be sold at discounted prices. Credit risk is the potential that securities or instruments in which the cash is invested default or sell at discounted prices due to changes in credit quality. To mitigate against these risks, BlackRock invests cash collateral in BlackRock money market funds that invest in diversified pools of high-quality, short-term securities and are subject to rigorous restrictions regarding credit quality, maturity, and liquidity. BlackRock brings sophisticated cash management capabilities to bear in this process. As of December 31st, 2020, BlackRock is one of the largest money market fund managers in the world, with $666.3 billion in cash assets under management. Now, this is what's crazy. How much of the securities lending proceeds are paid to iShares ETFs? iShares ETFs receive 77 to 82% of the income generated from securities lending. So what is BlackRock doing? BlackRock's been kicking the can down the road by lending out these securities, I think, to all these banks and other participants. For what purpose, though? I don't know. I'm not sure, because they voted in their GameStop shares, remember? They voted in their AMC shares, I believe. So I'm not sure what the motive is behind that. Who are they trying to get the bag here? Are they trying to prolong this until the SFT facility gets implemented? Like, what is going on here? But what I did find out is that BlackRock's iShares ETFs with GameStop and AMC in them, guess what? Share lending, baby, all day long to these banks. That's what's going on. You heard it from BlackRock's own words. Now, has there ever been a borrower default in BlackRock's history? Since BlackRock's lending program started in 1981, only 3 borrowers with active loans have defaulted. They don't give names, of course. In each case, BlackRock was able to repurchase every security out on loan using the proceeds of the borrower's collateral received and without any losses to our clients. Although borrower defaults are infrequent, how well prepared is BlackRock in the event it happens again? BlackRock's integrated technology platform and experienced team of professionals focused on all aspects of markets, trading, and liquidity put us in a strong position to manage collateral in the rare event of a borrower default. Additionally, our securities lending operations, portfolio management, and trading teams regularly assess our readiness to respond to a borrower default using various tools, which in a given year may include a borrower default simulation. Now, as an additional safeguard, BlackRock provides an indemnity for its ETFs for a shortfall in collateral in the event of a borrower default. If a shortfall were to exist between the collateral amount received and the cost to repurchase the loan security, and that shortfall is not due to reinvestment risk, BlackRock would reimburse the fund in full. Now, key word there, not due to reinvestment risk. So, don't know. But as far as I know, these ETFs, they're all the shorts. They got to be. Because, again, remember? Let's go back to the beginning. No, we can't. Never mind. Well, shit. That's what you get when you try to record something new. So you heard that, right? And you saw that, right? Now, what worries me is it just hit me when I read that again. So BlackRock is going to go and they're going to pay out all these ETFs and reimburse the fund unless what? Unless unless it's because of market risk. Well, what did they define market risk as? Price increases of the underlying securities. So yeah, I mean, this is it, everyone. It's the ETFs, the share lending. It's the ETFs, the share lending. The ETFs, the share lending. The fails to deliver, the shorts, the naked shorts. It's all coming from share lending. The repos. That's what a repo is. It's share lending. Same effect on the market. So there you have it, folks. It's all share lending. Make sure you turn that shit off, people.